What's next for markets?
Hello, I'm Stephen Gregory. I head the quantitative research effort, Piper Sandler. I'm filling in this week for Michael Kantorowicz. I'm joined here today by Emily Nadell, who is the Deputy Chief Investment Strategist at Piper Sandler. And today we will be discussing small caps. Let's jump right in. Hello, Emily. Thanks for being here today.
Stephen, it's great to be here. Thanks for having me on.
Yeah, I'm excited to be talking about small caps today. They are, by definition, small. They make up a smaller portion of the equity market, but they're super important, and they've been the backbone of a lot of investor frustration. Can you talk about that a little bit?
Yes, absolutely. And I think frustration is a key word when it comes to small cap investing over the last couple of years. 2025 here is actually the fifth year the Russell 2000 has been underperforming the S&P 500 in a row. And we've seen this continued underperformance of small caps, but we've seen big movements. So we've seen short-lived pops where small caps have outperformed large caps for short periods of time. And we've heard a lot of enthusiasm from investors that think that this is finally the time for small caps to break out. And those periods have been when we've had really good news. Over the last couple of years, when we saw inflation peak after the COVID run-up in inflation, when we saw the Fed was finishing their hiking cycle, when the Fed started cutting, and then most recently after Trump won the election. And so we started this year with a lot of optimism about deregulation and pro-growth policies, but it hasn't panned out. And we're basically now at a point where the relative performance of small to large is making new lows that we haven't seen in several years. And so anytime that investors got excited about small caps, they've been burned in the last couple of years. And so that has really caused a lot of frustration because it's just been enthusiasm and then underperformance.
IWM that you mentioned there, so that's the Russell 2000 ETF, has been one of the most crazy charts to look at over the last couple of years. You've seen just a ton of price movement, but gone nowhere. So you've had volatility and essentially no return. Not a good Sharpe ratio on that trade. But it is such a interesting juxtaposition from the last couple of years to coming into this year, where you had so much enthusiasm about deregulation. This was finally that catalyst for small caps to do better. What are some of the reasons in your eyes why investors kept wanting to hope for the small cap trade? What was pushing investors and market pundits and all these people to continue to be like, it's the time for small caps. It's the time for small caps. Even though now we know that's basically been a widow maker for portfolios.
Sure, that's a great question. So small caps have historically been higher risk, higher reward. So when you look back in time over history, small caps outperformed large caps from the late 90s all the way into 2018. You saw small caps outperformed most of those years. And then what we've seen recently is that small cap valuations have just continued to look attractive relative to larger cap valuations. And so a lot of people are very valuation focused. And so they saw those attractive valuations and thought of it as a good entry point for small caps. I think that one of the issues when it comes to looking at valuations in that context is valuations change with the backdrop. And as a team, we never like to look at valuation as a catalyst to get into a trade. And that certainly has been the case with small caps, because even though they had cheap valuations, they just continued to get relatively cheaper to large caps as we've seen that consistent underperformance over the last couple of years.
And you bring up a good point about kind of valuations compared to large caps. When looking at the market, whether you're an advisor, self-managed, or portfolio manager, those large cap stocks have gotten so big. And I think anytime a portion of your portfolio gets that big, we're taught to pare back that risk. And whether you're talking about the Mag 7 or the top 10 stocks in the overall index, the weight of those stocks has reached astronomical proportions.
Absolutely. And I think people have been looking, to your point, they've wanted to diversify away from the Mag 7. And with valuations of small caps looking attractive, people had been thinking that was a good way to diversify away from that mega cap trade. So certainly that is something that we've seen a lot of, and we've heard a lot of in talking with clients, that they are looking to small caps as a way to diversify away from that mega cap exposure that they've gotten to have so much of in their portfolio as those names have gotten to be so huge in the index.
And you couple that with the kind of history of in equity markets, investors have gotten paid to take risk, and small caps tend to be a little more risky. They are the beneficiaries of a stronger economy. And for the most part, we've had long-term economic growth. It definitely fluctuates around. You have market cycles, but investors have been rewarded, which is such a different case than what we've seen over the last couple of years. And Some people may look at it and be like, well, it's small caps. Who cares? Small caps play a very important role in an overall diversified portfolio, even though it's a smaller percent. And they're such an important barometer of economic strength and that kind of grassroots economic foundation that really does propel markets, maybe not over the next 3 months, but over the next 6, 12 months. What's holding them back today? What are the issues?
Great question. So I think we can really point to three primary reasons that small caps have struggled in the post-COVID world. We've been living with higher rates, slower growth, and now we're seeing rising risks with all the tariff news. And those three things have been just really major headwinds for the small cap trade. Higher rates and slowing growth have been issues for the last several years. The tariffs obviously is a newer concern that's erupted this year. Let's start off by talking about higher rates. So small caps are more sensitive to rates than larger caps, primarily being small caps have a lot of debt. Their debt to market cap ratio is about 35% public debt to market cap, whereas larger caps have about 15% public debt to market cap. So they have a lot more debt on a relative basis than larger caps. And they also pay a higher rate than larger caps do. It's more expensive for them to get borrowing. So in the last NFIB small business survey for the last month, they said that the average short-term loan for small caps was 8.9% for small cap businesses, which is an extremely high rate compared to what larger caps are paying. So the fact that we've seen rates stay higher for longer over the last couple of years, longer certainly than most people expected when the Fed first started raising rates, has been problematic for small caps. I mean, small caps really, they won lower rates years ago, right? I mean, this has been the longer rates stay high, the more problematic it becomes for small caps because they are now having, as their debt matures, they're having to take out more debt at these higher rates. It's just becoming very costly for them to continue to do business. And so with the tariff news recently, we are seeing expectations for higher inflation for longer, which certainly has put upward pressure on rates. We've seen a big pop in rates since the April 2nd tariff news. And so that just furthers the case that we're going to see even higher for longer rates well beyond what people were initially thinking. So that's the higher rate component. Then we've also been in a more of a slowing growth backdrop. We've seen significant bifurcation in terms of the economy since COVID. We've seen cyclical areas of the economy have been slowing, even though we have seen strength in other areas. And so that's this bifurcation has been a big buzzword for the last couple of years. PMIs, which we use as a measure of manufacturing activity, cyclical activity in the economy, they've been basically below 50 since 2022, which means that we've been in contraction territory in that section of the economy. So certainly not gangbusters for economic growth. And that type of backdrop is just not great for small caps, which tend to have very cyclically sensitive earnings. And so we have seen the earnings of small cap stocks has struggled over the last couple of years. Getting back to this concept of bifurcation, if we look back over the last couple of years, large cap earnings have grown since 2022, more than 25% growth in earnings, whereas small cap earnings have literally gone nowhere over that time period. They're flat compared to what they were back in 2022, and we're looking at it forward 12-month earnings. So no growth in small cap earnings, pretty significant growth in large cap earnings. That is, again, just a measure of the bifurcation of the economy. And so since we haven't seen strong growth across the economy, we have seen small caps lagging, certainly over the last couple of years. So that's higher rates, slowing growth. And then the third piece, again, as I mentioned, newer this year is tariffs. Many people initially thought tariffs could be a tailwind for small caps on a relative basis, since small caps do have less foreign exposure than large caps. If you look at the S&P 600, the small cap index, about 20% of the revenue for that index comes from abroad versus the S&P 500, which gets about 40% of its revenue outside of the US. And so people were thinking that with the tariffs, that might be bigger hit to the larger cap companies, but we just have not seen that play out. We've seen quite the opposite. Since the tariff news came out in April 2nd, and even before that, when we were starting to hear tidbits of what was going on with tariffs prior to that, small caps have been underperforming. There's been a flight to safety this year amidst all of this tariff turmoil. And a flight to safety does not include small caps. The flight to safety, we've seen investors favor defensive areas. So when it comes to sectors, they've been looking at the most defensive sectors like staples, healthcare, utilities. We've seen investors reach for stocks that have low beta that tend to get whipped around less than the higher beta counterparts. And small caps don't fit the bill on on those. Small caps tend to have higher beta. They tend to have weaker fundamentals than the large caps. And so, amidst all of this uncertainty that we're seeing, there just hasn't been an appetite for small cap and the risks that are inherent with small cap names.
That's really interesting. One of the charts we were showing this week was how in the original tariff announcement, you saw a drawdown that hit every class almost equally. I think all the S&P size and style boxes the week of the tariff announcements were within 1.5% of each other on the downswing on an absolute level. And then in the tariff reprieve or pause, the next week, it wasn't a proportional move higher. You had a much wider spread as people favored the larger cap stocks, despite that idea that they are less exposed to these foreign trends and the potential for a trade war troubles. That economies of scale, the safety, the less susceptible to what could be higher rates with now the Fed on pause, favored all those larger cap stocks. I thought it was so incredible that the week that tariffs were paused and you saw markets rally so sharply, small cap value actually had negative returns that week on an absolute level.
Yeah, I thought that was shocking as well. To your point, just to put some additional numbers to that, the week of the April 2nd tariff announcements, small value, which tends to be the riskiest of the size and style boxes, was down 9.9%. It was the worst performing of the size and style boxes. And then, as you said, the following week when we did get that relief and we saw the S&P 500 was up almost 6%, we saw that small value was the only size and style box that was down again. So it didn't really see any relief on that week. And I think it's largely because that we still have so much uncertainty out there, which is not a good backdrop for small caps.
Absolutely. So small caps equities do, for a multitude of reasons, have a place in your portfolio, but they really are the hatchery to growth and innovation. There's a lot of biotechs. There's a lot of regional banks. These are the foundationary aspects of, the strong economy. You just had this period of zero interest rates, which now is a huge headwind. But it can't stay like this forever. So what are some of the things that you see out there that could go right for small caps?
Certainly a reversal of some of the trends that have hurt small caps. So we talked about higher rates, slowing growth, and the tariff uncertainty being three major headwinds to small caps in recent years. If we were able to see rates come down, not because we're going into recession or because there's some bad news out there, but for good reasons, if we're able to see inflation cool, for example, that would be a positive for small caps. If we start to see an acceleration in growth, if we start to see less bifurcation in the economy and we start to see more broad-based improvement in the business cycle and in the economy, that would be a positive for small caps. And if we got some more certainty with regards to tariffs, that would be certainly a positive. The longer tariffs stay on, the worse it's going to be for small caps because they have less ability to adapt.
Yeah, that's something we've been writing about. You have more flexibility in your supply chain. You have the ability to negotiate better, move operations. You have the legal teams necessary. You also, larger caps have better fundamentals, stronger margins. You have more leeway where a lot of these small cap companies, especially as you move down away from Wall Street to Main Street, working on razor thin margins. You've seen it in some of the responses and commentary from companies in that these larger companies, the Walmarts of the world, feel like it's going to be an opportunity for them to gain additional market share. They're just way better positioned and can navigate a complex international backdrop a lot better.
Right. And so if we were to see a shift away from the administration from focusing on tariffs and moving more towards the deregulation and pro-growth policies, that would certainly be a better backdrop for small caps, at least in the short term. And so, again, anything that would foster a strong economy would be good news for small caps, again, because they do tend to be more cyclically sensitive. And one of the things that, in thinking about what impacts small caps, and again, it tends to be economic growth, and rates are also a big part of that, because again, they are so levered and they do pay a high rate, is that when we look at the economy and we look at other areas of the economy that are also very rate sensitive, housing is a big component of that. Housing, obviously, through mortgage rates, is extremely rate sensitive, and housing activity tends to be impacted pretty significantly and pretty quickly when we see changes in rates. And so for the last couple of years, we have seen higher rates has been a headwind for housing activity. We've seen higher prices, but also the fact that rates are so far above what most people currently pay on their existing mortgage means that we haven't seen a lot of movement and a lot of activity in the housing market. And so if we were able to get a situation where we saw rates come down enough to stimulate housing activity, that would be a really great backdrop for potentially a reversal in the small cap underperformance that we've seen. If we did get that lower rates housing activity, that would be, first of all, just a good backdrop overall for stimulating economic growth. But also, there is the housing activity has a lot of impact and touches a lot of other areas of the economy, of course. So you buy a house, then you pay the real estate agent, you buy the paint, you buy all the expenditures, et cetera. And so that has lead on implications for overall economic growth. And we think about housing and small caps in the same vein, not that they are one for one barometer of each other, but that they are both impacted by a lot of the same stimulus in the cycle and in the economy. And so if we have a good backdrop for housing, it's likely to be a good backdrop for small caps. And we have obviously seen several years where housing activity has stagnated. It is not likely to stay this way forever. People are going to have to move and we're going to see some movement. And if we are able to get rates to come down enough to stimulate housing activity, that would be likely a good change of pace for the small cap backdrop as well.
So, if you want to see a long term bull market with broad based participation and breadth and issues we've seen in markets unwind, you need to see housing and you need to see small caps have a better foundation for growth. And that just hasn't been what it's been lately.
Yeah, I'd like to maybe take a positive spin on it for a moment and just say that even though it has been really tough for small caps, if you are a manager trying to beat a small cap benchmark when your mandate is underperforming, it is easier to beat the benchmark if you lean into what has been working. And certainly what has been working in small caps, similar to what has been working in large caps, has been quality and stability. So there are plenty of names that are actually outperforming large caps. There are currently over 180 S&P 600 stocks year to date that are beating the S&P 500. So there are certainly opportunities if you lean into the right places. And so even though the index overall has been lagging, it's not as though there aren't opportunities within it as long as you're fishing in the right pond within the small cap space.
There's always opportunities if you look for it. And it's back to those kind of fundamentals of picking stocks and not just riding a overall secular wave higher. I love it, Emily. I think this is such a great conversation to have. Thank you so much for being here today.
Awesome. Thank you for having me.
We hope you enjoyed today's episode of What's Next for Markets. You can subscribe to the show on Apple, Spotify, YouTube, or wherever you get your podcasts. Be sure to follow Michael on X at Michael Cantro. If you like the show, please let us know by leaving a positive review. The preceding commentary is not financial advice. You should always seek appropriate financial advice from a professional financial advisor in your state. You should not consider this as a substitute for these services. Piper Sandler does and seeks to do business with companies covered in its research commentary or coverage. As a result, investors should be aware that the firm may have a conflict of interest that could affect the objectivity of this commentary. Investors should consider this commentary as only a single factor in making their investment decisions. For full disclosure information, visit www.pipersandler.com/researchdisclosures.